Morning and welcome to today's webinar, Navigating the Great Wealth Transfer. Is your estate plan ready? My name is Ben Burton. I'm a tax shareholder with the firm. I've been with Lutz for 18 years, and Tom Hodgson's joining me today.
Yeah, I'm on the Lutz financial team. I'm an investment advisor, and I've been an advisor for about 10 years. I've been with Lutz for about 5 years.
So today's agenda, we'll talk about the Great Wealth Transfer overview. We'll go through some inheritance considerations, talk about minimizing tax liabilities, some estate planning techniques, and then run through some next steps. A few areas about Lutz. So we were founded in 1980. We're headquartered out of Omaha, Nebraska. We like to boast about our Midwest values. We have 370 employees, and what we call the Lutz Network includes our accounting group, our financial group, our technology group, our M&A group, and our talent group. So with that, I'm going to kick it over to Tom to get started on the Great Wealth Transfer overview.
We'll kind of run through some kind of more so facts and data at first to kind of explain why this is becoming more prevalent in today's world versus, again, 20, 30, 40 years ago. So we'll kind of start with this. I think this is a kind of a really buzz word or phrase right now, but Cerulli, which is a research firm out of the East Coast, they're projecting that the wealth transfer in the next about 20 to 25 years is going to be about $124 trillion, with 105 trillion expected to go to heirs and 19 trillion to go to charity. Nearly 100 million or 100 trillion of that will be transferred from the baby boomers and older generations. So again, this is a very pressing issue. We're seeing it with a lot of the clients that we work with, and we really want to kind of think about, what's causing this and how we can help maximize some of the planning strategies around it. So I think the first thing that we kind of start by looking at is just a breakdown of the wealth that's out there. So again, you're going to see on this visual, the baby boomer demographic is the whole left side of this circle. And there's kind of a breakdown of what composes this bucket. Obviously, businesses and the value there is a piece of that. Real estate, some investment accounts, equities, mutual funds. Pensions is still a large portion of the baby boomers. But one thing that we'll kind of talk about is some changing trends that we're seeing in that space, especially as it comes to retirement planning, pensions in particular. And that kind of brings us down to that second bullet point. 401ks are, I would say, relatively new if you think about kind of the history of retirement plans. They were introduced kind of in the late 70s, with the Roth bucket really only being introduced in the mid 2000s. And that's where we're kind of seeing this trend change. Pensions were obviously something that I would say a lot of, again, maybe baby boomers and older may have participated in or have some combination of, but more and more people are saving for retirement on their own versus having their company set up a pension for them. So how does that impact things? Obviously, a pension had value where it was paying you a monthly amount. And a lot of times that would be set for yourself, maybe your spouse, depending on what options you have. But now with 401ks, there's a lot more times value left over upon someone's passing that is left kind of as a legacy asset. Another big changing trend that we're obviously seeing is healthcare is improving. People are living longer. So we're seeing these longevity statistics start to increase. And that obviously starts to increase some of these as well. There's more time for these assets to grow and compound. Again, if you kind of think of the statistics, for a person right now that's age 65, those are just the average life expectancy for male and female. Obviously, that there's going to be ranges of people that are sooner and that have a lot longer longevity. This is something that we want to start to think about as we're kind of planning ahead. Again, I think this trend is only going to continue to improve as people continue to live longer and healthcare continues to get better. So you can kind of see where this is headed. Again, longevity continues to be a factor that increases as you fast forward. And if we actually think about clients right now that are in their mid 60s, if we have a married couple that we're working with, there's actually about a 50% chance that one of them makes it until age 90. So obviously we're starting to see this that we're planning for more often, but that's also going to lead to, again, potentially more wealth that's being passed down from one generation to the next. Again, partially because we're seeing these assets grow. If you think about the household net worth and how this has changed over time, if you think back to 1990, so again, call that about 35 years ago, there was about $20 trillion of net wealth that was out there in the US. If you think you fast forward 35 years, we're now at $160 trillion. So that equals a 6% compounding growth that wealth is growing at. This is obviously a whole combination of factors. Businesses, a lot of times those are going to be growing potentially faster than that 6% growth rate. Stocks and a lot of your other investments are in real estate probably growing at that or a higher growth rate. Think of more like your cash assets. Some of those probably aren't growing at that fast of a growth rate. But again, when we kind of fast forward, we're seeing this continue to compound and grow, which is great for retirees, but it's also potentially leading to issues on kind of the wealth transfer.
And this is talking about, real estate, farm ground, stock. So this chart here is household net worth. It's not just looking at one specific asset class.
And again, obviously thinking here locally, obviously Nebraska farm real estate is another thing that we help a lot of, agricultural clients as well. This has been continuing the trend again across this area as well. And you can kind of see again, even like the annual percentage change. There's obviously years where that market can go down, just like we see with mutual funds and stocks and other investments. But as a general theme, we've seen that has continued to grow as well, and that certainly makes up a big factor for certain client bases as well. Again, another one here is kind of that business planning, and I think when we're thinking about the wealth, and a lot of the clients that we work with a lot of business owners as well. This is another one that we think is a key importance. Obviously, a big factor of your value of the business is the ability to transfer that. And so again, we talked about this in a previous presentation, so we won't go really deep into all specific business succession planning strategies, but I think it's just important to know that this does make up a big piece of a lot of the clients that we work with as well. One other interesting kind of little fact here is some lost retirement accounts. So again, you may have a great estate plan in place, you may have all your ducks in a row, but it's also not unheard of for clients to have forgotten about old retirement plans. And again, I think, the question up there is how do we get here? If you think about clients that are kind of in that retirement age window, so clients that are 62 to about 70 years old, on average has changed jobs about a dozen times. That's the fact from the AARP study. So right now there's actually, again, call it about $1.7 trillion of assets that sit in these lost or forgotten 401ks. One nice thing is now with Secure Act 2.0, there is actually a lost and found website that you can go on and look for some of these old plans that may be out there. But again, people change jobs. At that point, you may have, relocated, you may have moved from one state to another, you have a new address. A lot of times you have new contact information, especially thinking of like emails, maybe an old business email, things like that. But the other big thing here is kind of that power of compounding growth. So the current rules today in the Secure Act is that if you have a balance over $7,000 in an employer plan, the employer plan cannot force you out of that 401k. So again, I kind of just ran like a hypothetical situation. Let's say that someone was 30 years old, they had $7,000 in their 401k. They moved to a new company and they're like, oh, you know what? I'll get back to that here next week, next month, maybe a couple months from now. They forget about it. Life gets busy. And all of a sudden, if you think about that 30-year-old and you fast forward to retirement, that's 35 years of compounding growth. I just said if we had 35 years of compounding growth at an 8% growth rate, which again is I'd say a realistic rate of return if you were in an aggressive portfolio when you were 30 years old, that could easily turn into about $100,000. Obviously, if you have a faster growth rate, it could be more than that. So that's where you can kind of see that this average balance of 56,000 out there is not necessarily unheard of. So I would say if you think that you have an old plan out there, go and try to track it down. Because again, you probably have old beneficiaries listed. You might not have it exactly how you want on your estate plan.
Tom and I were talking about this when we were putting together the presentation. It's like, how could anybody forget about a retirement plan? But like Tom was saying, if you're changing jobs and moving states and you've got a lot of other things on your plate, or, you're even younger than 30, maybe this is your first job out of college and you get auto enrolled into the plan at your first job and you're there for 18 months or a couple of years and then you move on. I mean, you could definitely see how these accounts can get forgotten about down the road.
Yeah. All right, so now we've kind of laid kind of the outline of some of the data that's out there. We also want to think about some of the inheritance considerations. So obviously with the great wealth transfer, we're kind of thinking about it moving from one generation to the next. Obviously, every situation is going to be unique. You may, have charitable intentions, you may have kids, grandkids, family, friends that you want to leave assets to. But we're going to kind of continue on and think about some of these changing demographics as well. So again, if you think back to call it 35 years ago, the average age that a recipient was of receiving inheritance was about 41 years old. If you think back 10 years ago, it was about 51. Now, kind of looking at the end of last year, the approximate age is about 60. And again, this kind of lines up with what we're talking about with some of those longevity rules as well. So how does this change some things? When we think about, how this can impact people receiving assets, you think about, where they're at in their stage of their career. If you think about somebody who's in their mid 50s to early 60s, a lot of times that's when they're kind of in their peak earning years as well. So let's just say that, someone was 60, their parents were 85 to 90, and that's when they pass and left assets to them. Now all of a sudden they may have a windfall that they have to try to figure out how to control the taxes when they're also in their highest earning years. So, mom and dad could have done a great job of saving up their 401k bucket, having this tax deferred balance that now all of a sudden, they avoided paying a lot of taxes, but maybe their son or daughter is, let's say that they're very successful in their own profession or business owner, and they're in a top tax rate. Well, now all of a sudden they may have to start pulling distributions out over, again, right now, the current IRA rules are a 10-year window. There's obviously some restrictions on, how much to take out annually versus doing it in more of a lump sum on the back end, but they could be pulling dollars out in that 37% tax rate. So this is something that we're starting to think about with clients. And again, I think we're going to talk about this a little bit more, but you're seeing more and more people that start thinking about gifting during their lifetime versus upon their passing. And I think a lot of that comes down to, again, thinking about the tax liabilities and kind of planning ahead and figuring out how you can minimize that tax liability across the duration of a financial plan versus just any single calendar year.
So talking about some strategies with minimizing taxes, I think most of you are probably pretty familiar that the more your income goes up, the higher your incremental or marginal tax rate becomes. So, on the first 50,000 of income you make, you're only taxed at 10%, but if you're over 600,000 of income, those dollars above that are taxed at 37%. So, as Tom is saying, if you're somebody that's in your highest earning years, creeping up on those higher tax brackets, you're at an adverse time to be inheriting those, traditional retirement dollars that are going to just stack on top of your earnings. So, another component to be looking at is you've got ordinary income that is taxed at those brackets, and then you've got capital gain income that is subject to lower rates. You're typically in that 15 or 20% bucket. For a married couple, you don't hit that 20% bucket unless your income's over 600,000. But there's also net investment income tax that comes into play, which is an extra 3.8%. That's again on a married couple if your income's over 250,000. So just some extra tax rates and brackets to keep track of. So then running through kind of how items are taxed to beneficiaries. So if you've got assets that get transferred to your spouse on death, in general, those can be those can be transferred without tax implications, whether that's IRAs, taxable accounts, companies, land, etc. Those IRAs can be treated as their own. They don't have to accelerate the distributions. There's no 10-year rule that comes into play there. And then depending on how the assets are titled, if it's my spouse and I, and the assets are in my name and I pass away first, my spouse will receive those assets with a fully stepped up basis. If they're jointly titled assets, my spouse will receive those with a 50% basis increase. So just something to keep in mind when you're thinking about assets transferring between spouses. Then you got assets transferring to a non-spouse. So, traditional IRAs or traditional 401ks, those are going to have a 10-year distribution rules. So, based on the current laws that are in place, beneficiaries have 10 years to fully distribute those accounts. So no longer is it that they have to distribute a certain amount each year. They just have to get all of it out within that 10-year time frame. So, if you think about somebody that's, say 60 inheriting some money when they're at their highest earning years, maybe they decide, okay, we're going to delay taking any distributions until we retire because we're planning on retiring at, 65 or 67. And if I take those dollars out in, 8 years, I'm hoping I'm in a tax bracket that's in 20% range instead of in that 37% range. Or we'll touch on this a little later too. Maybe I'm planning on moving to a state that does not have any income tax. So, if I'm a resident of Florida, when I start taking those dollars out, well, I'm taxed at Florida's tax rates, which are zero. So now instead of being in Nebraska's 6% or 5% state tax rate, I'm only in Florida's 0% rate. So these rules apply to trusts as well. They get to follow that 10-year rule. And then if you think about after-tax accounts, those would receive a full basis step up on at death. So, if I was somebody that had held UP stock for a long time and my basis was zero and it was worth, $150 today, well, when I pass away, if that goes to my son and it's in a taxable account, well, now his basis gets the step up to today's fair market value of $150. So if he turns around and sells it, there's really minimal tax implications on those after-tax accounts. And then, charities, charities don't pay tax in general. So, if it's left to a 501c3, they're not going to be concerned with what the tax implications are. So this would apply also to donor advised funds, foundations, and includes retirement plan accounts as well. So, oftentimes when we're consulting with clients on what their charitable intent is with their estate, we'll push them to, if they want to leave assets to charities, do it with your IRA or your 401k. Those assets aren't eligible for a basis step up. And so if an individual's receiving them, they're going to pay tax whenever they pull money out. Whereas if an individual receives after-tax money, gets the basis step up, that's not going to be subject to tax.
So, and I think some of this is just about communication between you, your spouse, and the next generation, or who you want to leave these assets to. Because again, there will have some trickle down impacts on your kids and or grandkids, depending on how your estate plan is set up. Let's just say that you have mostly investment accounts. Those do get a lot of step ups. And then a lot of times from there, you have dividends and interest that start to pay out to the beneficiaries. So even though they get a full step up, there may still be some kind of trickle down tax impacts. Same thing with like real estate or a business. Again, maybe you leave that to the next generation that gets a full step up basis. So it's not kind of that immediate tax impact. But all of a sudden, if the family farm got passed down and then, your son or daughter is receiving income off of that, whether it's cash rent or however that's structured, all of a sudden that starts to add more of that ordinary income back to their bracket, depending on where they're at. And then again, same thing with those IRAs. If you have charitable intentions, that could be a good bucket to leave to those different organizations. Or with those IRAs, again, following that 10-year rule, the beneficiary's age may be a big factor of that. I know Ben talked about kind of letting them kind of grow for 8 years or 10 years and then pulling out the back end. But again, that could also have a snowball effect impact where, again, let's just say you have $1 million IRA, you have 10 years to pull it out. maybe you do take some out those first few years. And some of that, the requirement is based off of, if your mom or dad, when they passed, were of the RMD age, they still have those RMD requirements. They can kind of just delay kind of that lump sum to the back end. But maybe it makes sense to trickle some out earlier. Or let's say you are working currently and maybe you haven't yet maxed out your 401k. You could also start to increase your own salary deferral and take money out of those inherited accounts, kind of do like a left pocket to right pocket transition, where you're adding taxable income, but then you're also decreasing your own taxable income. So there's a lot of different strategies to think through when you're kind of planning on this side of it. But again, I think communication can be a big factor of, again, knowing what's coming down, especially as you start to get in this phase where maybe you've gone through your financial plan, there's going to be excess legacy assets, and you want your next generation to start to plan ahead for that. This is a good time to have that communication with them so they can think about their own situation.
So this slide kind of looks at what the potential impact is of Secure 2.0 pushing that RMD age back from age 70 and a half, which was the previous year age that you had to take your required minimum distributions, all the way back to age 75. So if you look at an IRA account that was at roughly $1 million, and this is under the assumption that you're not taking out anything other than the RMD, and you're delaying the RMD until you start. So, if you look over there on the right-hand side of the chart, based on RMD starting at age 75, it's able to grow to almost $2 million by the time you're in your mid-80s, compared to if you had started taking those RMDs at 70 and a half, it's roughly, 1.6 million. So it's an increase of almost 400,000 in value, or 25%. And that's, if you're just looking at what asset values are going to be down the road and how that growth really compounds on itself.
Yeah, and I think a few other takeaways that I think about when working with clients on this end is, again, those RMDs, that amount, like if this IRA goes to your spouse, and let's say your spouse survived you for 5 years, the RMD doesn't go down because there's now one person. They inherit that as their own account, and the RMD factor stays the same. So now they're taking out that same amount they were required to, but now they're on a single tax bracket versus a joint tax bracket. So that's one consideration. And then also thinking about the number of beneficiaries that you have. Again, if you have one child, you're leaving a large amount to that one child while they're potentially in their peak earning years. If let's say that you have 4 kids, you're dividing this balance by 4, that's maybe a little bit more manageable, that you can spread those out over multiple kids' tax brackets. So this is I'd say, very important consideration, but also should be thought of kind of on your own situation basis.
So we're talking a lot about Roth accounts and traditional retirement accounts. So, just some factors to keep in mind when you're kind of thinking about your own situation and determining what's best for you. So knowing your current marginal tax rate, what's the impact of the next dollar earned? What do you expect for a retirement tax rate? I mean, hard to look into the future and determine exactly where taxes are going to go down the road. The closer you get to that retirement age, maybe the more comfortable you are with where you think taxes are going to be. I mentioned earlier, will you be moving after you retire? Do you plan on spending more time in Florida or Arizona? In Arizona and Nebraska have a similar tax rate, Arizona a little bit less. Florida or some other states have a 0% tax rate. So kind of considering what do you expect from that standpoint. And then, as you continue to analyze your own estate plan, what's your beneficiaries' tax rates going to be? When you think you're going to be able to transfer assets down to them. Other considerations, what other income sources will you have in retirement, whether that's Social Security? Tom talked about pensions and them dying out. So for a lot of our younger clients clients who aren't pension aged, that probably isn't as much of a factor. But then, are you going to continue to own any businesses that are going to generate income for you? You know, real estate that you're going to hold long term will continue to generate income. So, what's your other income sources in retirement? Keep in mind the tax torpedoes of Social Security and Medicare. I mean, Social Security is up to 85% taxable. So if you've got other income sources, Social Security, even though you've already paid tax when you were paying into it, that those dollars are taxable. And then your Medicare premiums are based on your income levels. So the higher your income tax rates, or the higher your taxable income is during your retirement years, the more you're paying for your Medicare premiums. So if you're in a traditional account, when you pull those dollars out, it increases taxable income versus in the Roth. Talked about legislative changes. Tom mentioned, longevity when one spouse passes away, now the other spouse is going from a joint tax brackets to single tax brackets. And then, what are your charitable intentions down the road?
And I think even one more note on like the state tax rates and legislative changes. Obviously, we don't know what could happen that way, but obviously we work with a lot of clients in Iowa as well. Iowa recently passed a tax law for retirees that you don't pay ordinary income on IRA distributions and pensions and Roth conversions, but you do while you're working. So that's another consideration that, again, if you're working in your higher tax bracket, it may make sense to defer into that pre-tax 401k or IRA, then later pull it out because there's, an immediate tax savings. And we don't know what other states are going to do on that side of it as well. Obviously, that kind of, we talk about federal legislative changes, but it's also on the state level also.
So this is kind of a look at a three bucket approach. So you've got your Roth bucket, your pre-tax or your traditional retirement plan bucket, and then your taxable account. So with the Roth, you pay taxes now, but all of your distributions, including growth, are tax-free. And then your beneficiaries get that same tax treatment. So we would say anyone who expects to be in a higher tax bracket in retirement, or you're trying to diversify your retirement assets, this would be a good bucket to fill up. The traditional accounts, if you want that tax deduction now, as Tom was talking about earlier, maybe you're in your high earning years and you start to receive an inheritance. Do you want to start putting money into that traditional bucket so you can reduce your income? And when this gets pulled out, it's going to come out as ordinary income. It's subject to both federal and state tax, and it's also ordinary income to the beneficiaries who would be inheriting it. And this would be a good bucket for anyone who expects to be in a lower tax bracket in retirement. So I think, if you think about your company 401k plan, even if you're in a Roth, even if your deferrals are going into a Roth, your company match is typically going to be going into a pre-tax plan. So oftentimes it's, hey, let's get some dollars in both buckets because we don't know what's going to happen down the road. So, if you're getting some of your deferrals into a Roth, your company match is typically in a traditional. So now you've got, some assets in both buckets. And then that third bucket over there on the right-hand side of the screen is your taxable account. So this is after-tax contributions for individuals. Growth is taxed as capital gains when you sell it, and then the dividends and interest are taxable as received. Dividends, if they're qualified dividends, get that similar beneficial tax treatment as capital gains. Interest taxed as ordinary income. And we typically see this with clients who've already maxed out their employer plans and have excess dollars they want to put away for retirement, and this just gives added flexibility.
And I think a takeaway here, and I'm just going to reemphasize what Ben had mentioned, but in a perfect world, I think it would make sense to have some in all three of these buckets. Then you can control your taxes a little bit better throughout retirement. So again, you can pull out a certain amount from that pre-tax bucket and fill up those lower tax rates. But then you can either use the taxable account or the Roth to take any large distributions. Again, maybe you need to fix up the house you're in renovation, so you have a large year where you're taking income out, or you're buying a vehicle, or you've got a big trip, or maybe you're doing some gifting generationally down to the next generation, and you don't want to have to pull just from a pre-tax account to do that. So there's some considerations here, and we always talked about this. I think the hard part right now for retirees in today's world is that the Roth bucket wasn't that common until the last 20 years. And again, let's say that you were a high income earner for the last 20 years, you may not have, good parity between these three buckets. So now starting to kind of think about your financial plan and saying, hey, should we start to trickle some out in those lower brackets? Maybe do some Roth conversions in that tax planning window. Again, this is very unique to each person's situation. But, if a client retires at 55 or 60 versus 65 or 70, that's a big difference before Social Security hits and you have some other income coming in from like those required distributions. So I think that's definitely something that is worth thinking about, having these different buckets and when to fill each of those buckets.
So this is a historical look at tax rates. That blue line is the capital gain rate. And as you can tell, for the majority of time since 1954, capital gains rates have gotten beneficial treatment compared to the ordinary income tax rate. And I mean, it's crazy to think that 60 years ago, there was a 90% tax rate on the top tax bracket. And this is also to say, historically we are in a lower tax rate environment. But politicians typically don't die on the hill of we want to raise tax rates, but you look at the federal deficit and other areas, and it seems like tax rates are going to have to go up again at some point.
And I would even say, again, I think you can use this chart and say it will probably change throughout your retirement. There's probably going to be windows where you are in lower tax rate environments throughout your retirement. There may be windows where you're in the higher tax rate environment. Obviously, we were at the point before last year's tax bill that the tax law was going to sunset and they were going to increase by 2 to 3 percentage points back to what it was kind of right there before that 2017 drop on that kind of orangish line. So again, I think it's just worth noting that this can and probably will change. I don't think Ben and I are in decanter. We're going to try to forecast what's going to happen on this side, but just knowing that there's going to be a constant change up or down as we have different administrations get into office and different things that are kind of pressing at any given time. But again, I think controlling your own destiny a little bit is kind of the message here. And when we're in these lower tax rate environments, maybe that's a good time to fill up that Roth bucket or kind of fill that taxable account versus the pre-tax bucket.
So this chart is on estate tax and the estate tax exclusion. So 25 years ago, if you had an estate that was valued over 675,000, it potentially was subject to a tax rate of 55%. So you compare that to today's estate tax exclusion of 15 million, and 25 years ago, you probably would say almost everybody was subject to estate tax, versus today in 2026 at 15 million, there's a very limited amount of individuals that are subject to that estate tax. And, the rate was 55%, now it's 40%, so it's come down a lot. But this still has, an impact on the clients that we work with, especially if you're talking about business owners where it's, hey, is my company valued over 15 million? Maybe. But, my beneficiaries aren't going to have a lot of liquidity if they inherit, my company stock, because they'd have to sell the company to generate enough to pay that tax bill. So making sure, whether it's a business owner or, a farmer that's got a significant amount of farm ground that's over that threshold where it's just not a very liquid asset, and keeping tabs on, what are we doing to make sure we're able to take care of that estate tax, and then how do we plan on distributing those assets? How do we maximize what's going to our beneficiaries?
And I even think on the legislative side of things here as well, again, the one big beautiful bill did make this permanent. And I always say that in air quotations because it's only permanent until there's another administration in office that proposes a new bill that can potentially get enough votes to pass. If they hadn't extended it and made permanent, it was going to sunset back to what it was, back in 2017 with an inflation adjustment. So there is a chance that this could go backwards. Now, again, I don't know what that looks like. But it's just something that's worth noting is, again, we always operate under the rules that we know, but also put a caveat knowing that this could change.
So from a state perspective, if we just purely talk about Nebraska, so Nebraska doesn't have an estate tax, but there is a county inheritance tax. And so just to give you some awareness on that, and Nebraska's inheritance tax system, that's all administered through the courts. So it's more of a legal tax, not necessarily an income tax or anything that we would help you out with. But transfers going to surviving spouse are not taxed at all. Transfers to parents, grandparents, children, once you get over over $100,000 going to a specific individual, those transfers are subject to a 1% inheritance tax. If it's a more distant relative, subject to an 11% tax, that only has a $40,000 hurdle. And then anyone that's unrelated, that hurdle goes down to 25,000 and the rate goes up to 15%. And this applies to gifts that are made within the prior 3 years before death as well. So, one of those pieces from an awareness perspective, where if you've got plans to have money go to, unrelated friends or neighbors, maybe you start to do life gifts while you're still living so that the minimum amount is subject to that inheritance tax. And likewise with some of those other relatives that you might be looking at.
And I was going to say, we see this in our practice. Again, we have clients that want to leave money to their nieces or nephews, or maybe it was a long-time employee of the business that they consider very valuable that they want to leave assets to. This is where we would make a recommendation of giving during your lifetime versus upon your passing. And I think the other big one that is sometimes not necessarily well thought of, but again, let's just say that we had an 85-year-old client that was widowed, that found a significant other later in life that they now, again, consider really close that they would want to leave an asset to upon their passing. They would still fall in that, again, kind of that 15% bracket because it's not actually a spouse. So there's some considerations that maybe fall outside of that realm of what is maybe most common, but still, very impactful. I think those are some things that we kind of always recommend or think about.
Okay, so here's some simple items to be thinking about as you think about your own assets. So, should you spend it or give it during your lifetime as opposed to your beneficiaries inheriting it after you pass away? So you can do lifetime gifts of $19,000 to each individual. So, if I'm a married couple, that doubles from 19 to 38. If I'm gifting to my kid and my kid's married, well, now that doubles again from 38 to 76. So, if I've got a big pot that I'm thinking is going to be that I don't want to have subject to any of those estate or inheritance tax provisions, we can start to gift that away during our lifetime. We can fund 529s for kids and grandkids, or pay the tuition directly or pay medical expenses directly. So if I'm paying the tuition or medical expenses, that doesn't count towards the $19,000 limit. So that can potentially be an area where you can really move a lot of money on an annual basis outside of your estate. And then the other thing to keep in mind with the gifting is I can gift 19,000 before I have to file a gift tax return, and then the excess amount above 19,000 starts to eat into my $15 million estate exemption. So even though I'm gifting over the limit, there's not really any income tax or estate tax implications until you get over top of that 15 million. So you can also donate it, give to the charitable causes you support now versus waiting until you pass away. It can go to charities, donor advised funds, foundations, as IRA beneficiaries. So you could do, we'll talk a little bit later about the qualified charitable distributions, but naming those charities on as IRA beneficiaries instead of that going to the individual heirs can get out of that ordinary income tax treatment. And then, as you prepare for potential estate tax implications, do you set up some type of irrevocable life insurance trust to help cover any estate tax liability? Do you, reduce the size of your overall estate by converting from a traditional IRA to Roth and paying the tax, knowing that then your beneficiaries aren't going to be subject to that income tax down the road when they inherit those assets? Some charitable giving comments. So, if you're giving during your lifetime, you can look at using a donor advised fund. One thing you can do when you set those up, you can donate appreciated securities, and that way you can avoid paying the cap gains tax if you were to just give cash. So instead of recognizing the capital gain income and donating cash, you can just contribute those appreciated securities. You can also look at, what we call charitable bunching. So from a income tax perspective, a married couple has a standard deduction of 32,000. So oftentimes, unless clients are donating a significant amount of money, they're not going to be able to itemize on an annual basis. So, if someone says, hey, we're going to donate 20,000 a year, and we've paid off our mortgage, so we don't have a mortgage interest deduction, and we're subject to that $10,000 state income tax deduction limit. Well, 20,000 plus 10,000 only gets you to 30,000. So now your 20,000 of donations really doesn't benefit you from a income tax perspective. But let's say you did a 3-year charitable gift to the donor advised fund. Well, now I've gifted 60. I'm going to get that full tax benefit. And then I can choose to spend that money out of the donor advised fund over the next 3 years. And so now I've gotten the tax benefit in 1 year, and I can take the standard deduction those years going forward. The qualified charitable distribution. So, once you're age 70 and a half, you can elect to have money go directly from your IRA to a charity. Those dollars count towards your required minimum distribution, and the limit for 2026 is $111,000 a person. So in this case, it doesn't count as income to you because it's going direct to the charity. So it doesn't increase your AGI, it doesn't push you into a higher tax bracket. And the charity's getting the money. So even if you're taking the standard deduction, you still get the benefit of the dollars going out to the charity.
And I think one additional note on giving to charities during your lifetime, this does have some changes with the new One Big Beautiful Bill Act. So again, you can do $2,000 of cash gifts and deduct those even if you're taking the standard deduction. And then again, thinking about that 0.5% AGI floor for charitable gifts, where you don't get to count the first 0.5% of up to your AGI. So I would say, keep track of receipts now. Obviously, we're in a new year where giving is going to be maybe a little more beneficial. But otherwise, I think some of these bigger items like the bunching and appreciating securities is really kind of getting the best bang for your buck on the gifting side.
Okay, so we've touched on these 2 points a little bit throughout the discussion here today, but if you're going to leave assets to charities after death, it's most beneficial for those individuals receiving dollars if your IRAs and traditional retirement accounts are going to the charities as opposed to those after-tax dollars that are going to receive that basis step up and not be subject to the ordinary income tax. So, on your IRAs or retirement accounts, name the charitable organizations as beneficiaries, and you can designate partial or full percentages to each charity. And it's more tax efficient than leaving cash or taxable assets. You can also leave money to your donor advised fund. And in that case, wherever the successor advisors can carry on your charitable intent. So, if you want your kids to have some say in how those charitable dollars get split up, you can name the kids as advisors, and then they're able to earmark where those dollars are going to go. A couple trusts that you might come across when you're talking with your own advisors about estate planning. There's some acronyms to know. So there's a GRAT, a grantor retained annuity trust, a SLAT, spousal lifetime access trust, an IDGIT, which is an intentionally defective grantor trust, an ILIT, irrevocable life insurance trust, and a CRT, charitable remainder trust. So these are some trusts that I would say are pretty common in high net worth estate planning. I know we've gone over those in a little more depth in previous webinars. So if you got questions on those, you can look those up at that time. But just kind of a slide on awareness. So now we're going to send out our polling question just to make sure we haven't put everyone to sleep. Okay, we'll keep going here. So today's discussion is just about an awareness and the increased need for estate planning that we've kind of been talking about. So as trillions of dollars in assets shift generationally, families must revisit wills, trusts, and beneficiary designations to ensure alignment with current goals, tax laws, and family dynamics. Doing nothing also has tax consequences. So, talking a little bit more about the Nebraska laws. Nebraska has intestate laws, so if you die without a will, they will, administer your assets according to the state's plans instead of your plans. So the one that's most surprising to me is if you have a all children from living spouse. So that means your spouse gets 100,000 plus half of the remaining assets, and your children get the other half. And then similarly, if you have living parents and no children, your spouse gets 100,000 plus half, and your parents get the other half. So, it's much more beneficial to have an estate plan in place, have wills or living trusts in place, depending on what's best for you based on the advice you get from your attorney. But as you can tell, if you don't have any plan in place, there's definitely going to be some unintended consequences. And then, if you do not have a spouse, or you're not survived by your spouse, the estate plan there could go to kids or parents or siblings. So making sure you have something in place so that you can be the one that dictates where your assets go, not the state. So we've got some comments on wills versus trusts, and again, definitely need to consult with your attorney on what you need to have in place for your specific circumstances. But wills are going to designate your personal representatives. They're going to designate guardians for your children and serve as a backup plan if assets are not retitled or do not have designated beneficiaries. Trusts are going to designate the trustee. They can hold title to assets during your lifetime, can help avoid probate if structured properly, provide an added layer of privacy, and allow for more precise control over asset distribution. If you think about if you have minor children and you pass away, and let's just say you didn't have a plan at all, well, now potentially minor children are going to get assets at an early age, which you probably didn't want to have happen, versus if you've got assets titled inside trusts, you can set certain timelines or age requirements for when those beneficiaries would start to receive distributions. So the trust can give you a lot more control over what happens with your assets after you pass away. Some common trust types. So you got testamentary trusts that are established by your will and created after death, and assets are not titled to a testamentary trust until after death. So this is typically probably like a family trust or a marital trust. Those trust names are typically given to testamentary trusts. You've got revocable or living trusts. Those are established during your lifetime. Assets can be moved in and out of these trusts, and the terms can be changed and amended during your lifetime. And then you've got irrevocable trusts that you establish during your lifetime. Once assets are gifted into these trusts, they are an irrevocable gift, can't be undone, and there's limitations on changes made after these are created. A couple of benefits to having assets in these irrevocable trusts. You get credit, you get asset protection from creditors. So if you're subject to lawsuits, creditors can't go after assets that are in these irrevocable trusts. and these assets are also protected during divorce proceedings. Special needs trust, we'll see these where clients have a special needs beneficiary that they want to maintain government eligibility for, and then spendthrift provisions limit distributions to specific intentions and prevent reckless spending. So instead of $1 million going outright to a beneficiary, you can stipulate that they can only take out a certain percentage of the assets on an annual basis for a certain dollar amount. So just more ways to give you control over what happens with your assets after you pass away. Some additional planning documents to keep in mind. And I'd say if you're working with a good attorney, they're going to be all over these, but the financial power of attorney, medical power of attorney, a written statement outlining medical treatment preferences if you become incapacitated, so an advance directed, beneficiary designations, to coordinate with your estate plan. Oftentimes clients think, oh, I've got my will set up with this attorney, and we'll start talking through it with them, and it's like, well, you didn't change any of your beneficiary designations. So making sure you get your designations caught up to date after you go through that plan with your attorney are essential. And then guardianship, who's going to care for your younger minors, and then consider separation of guardianship, financial trustee roles. Do you want the person taking care of the kids to be in charge of the trust as well? Or, should those be two separate individuals? And all of these things come down to, you want it tailored to your family's specific needs. As we work with more blended families or families that have complex assets, it's like, well, we don't want to just go with the generic one plan fits all. We want to make sure that clients are getting these tailored specifically to their needs, and then making sure that these plans are carried out exactly how you wanted them when you were drawing them up, and not being done otherwise.
So I think when we kind of wrap this up and think about action steps, you're like, what can you take away from this? What can you kind of put into place? So one, I'd say start now, create a financial plan, make sure that, that your retirement plan is set in place, your legacy goals are accomplished. Again, those can update. Obviously, life changes. Maybe, again, you don't have grandkids now, but you do 5-10 years from now. These can change. These are definitely something that would adapt over time. Review these documents, especially on your estate plans every 3 or 5 years, especially after major life events. Again, if you have, I even think of this from like a powers of attorney perspective. Let's say that you've got multiple children, one son or daughter currently lives in the same area as you, but they move across the country. That might be a time that you want to change who's your medical power of attorney. So, some of those major life events, not just for you, but also for some of those people in those positions of power, think about some of those implications. As kids shift from being minors to adults, maybe they become ready to be, in those capacities. A big one, updating beneficiaries. Ben talked about this, just making sure that your estate plan and those documents are all coordinated. Again, that could have unintended consequences if you had an old beneficiary listed, but you made a new estate plan. So make sure you get those updated, review those powers, powers of attorney, those people in those executor and trustee roles. And then also monitor legislation. Obviously, that's that we help a lot of our clients with, is keeping, up to speed on what changes happen, like the One Big Beautiful Bill last year, but other changes, and obviously consulting your professional team to make sure that, what you have in place is current, that it does match the current legislation and your current goals and intentions. So with that, we will turn it over to questions. I know we had a few come in during the presentation, so we'll kind of start there. The first question was, is a Roth conversion means tested or income tested? The answer is currently no. So you could be making $1 billion and still do a Roth conversion if you wanted. You would just be paying at that top tax rate. There was potential legislation that got proposed probably 3 to 5 years ago that said if you made over a certain dollar amount, you couldn't do Roth conversions. That didn't pass. So currently, there is no income phase out for Roth conversions. There is an income phase out for your normal Roth contributions, but there's also a workaround like a backdoor Roth if you don't have any IRA balances. So again, I would say consult your CPA, consult your advisors to make sure you're following all those steps, but you can certainly still do Roth conversions.
And I think we've hit our time limit, but we will be posting the recording, the presentation materials, and a survey here later today. So be on the lookout for those.